All right, let's talk about something that affects every single one of us every single day, but most of us don't really think about it. I'm talking about monetary policy. It's this kind of invisible hand that messes with everything from your savings account to how much you pay for groceries. So today, we're going to pull back that curtain and see exactly how it all works. You felt it, right? That feeling where you look in your wallet and the cash just doesn't seem to go as far as it used to. I mean, not like it did last year, and definitely not like 5 years ago. Well, that's not just in your head. It's a real thing, and it's driven by the very policies we're about to get into. Figuring out why that happens, well, that's what we're here to do. Okay, so first things first, what even is monetary policy? We're going to break down the official definition for sure. But, and this is just as important, we're also going to clear up a super common mix-up about what it isn't. And yeah, you might be a little surprised. So, at its absolute core, monetary policy is just about managing the money supply. The best way to think about it is like a giant financial spigot for the whole country. You can turn it up to get more money flowing, which encourages people to spend and borrow, or you can dial it back to cool things off when the economy's running too hot. It's all about regulating the total amount of cash and credit that's sloshing around out there. And the whole idea behind this, the theory, is that how much money is available is like a primary driver of the economy's ups and downs. Think about it. If you have way too much money chasing the exact same amount of stuff, well, prices have to go up, right? That's inflation. On the flip side, if there's not enough money to go around, people stop spending and the whole economy can just grind to a halt. The big goal here is to keep that money supply perfectly in sync with how the economy is actually growing. Okay, and this is a really crucial point, so listen up. Monetary policy is not the same thing as fiscal policy. People mix these up all the time. So, monetary policy, that's the central bank's job. For us in the US, it's the Fed, and they control the money supply. Fiscal policy, that's Congress. That's all about taxing and spending. So you've got two totally different toolkits and two totally different groups of people in charge. Now, to really get why managing all this is so important, we need to look at what happens when it goes completely, horribly wrong. And believe me, this is one heck of a cautionary tale from history. So, picture this. It's the 1920s. You're in Germany or Austria or Hungary. World War I is over, but the economies are an absolute wreck. The governments are broke. I mean, teetering right on the edge of total bankruptcy. They were desperate, and they needed a solution fast. And what was their big solution? They just fired up the printing presses. They started printing insane amounts of money, but here's the kicker. None of it was backed by anything real. No gold, no economic value, nothing. It was a Band-Aid solution that was about to cause a catastrophic wound. And this unleashed a monster. We're talking about something called hyperinflation. The value of their money just fell off a cliff. It plummeted so fast that it became almost worthless. I mean, literally overnight. The money you had in your pocket today, by tomorrow, it was worth a tiny fraction of that. And this is where it gets just wild. The situation got so bad that people were using sacks to carry enough money to buy food. Some people even used wheelbarrows full of cash just to get a single loaf of bread. Can you even imagine that? Money had become meaningless paper. This really shows you what's at stake here. This kind of economic chaos, it doesn't just live in spreadsheets and government reports. No, it spills out into the streets. When a society's money collapses, it becomes a breeding ground for anarchy, violence, and, political extremism. In fact, a lot of historians point to Germany's hyperinflation as one of the things that helped pave the way for the rise of fascism. The stakes are incredibly high. Okay, so to stop that kind of disaster from ever happening here, the United States has a special institution in charge of all this. Let's meet the Federal Reserve, or as you've probably heard it called, the Fed. Think of them as the nation's economic pilot. Now, the Fed isn't just some big marble building in DC. It's actually a whole system. At the top, you've got a 7-member board of governors. Then there are 12 regional Federal Reserve banks scattered all over the country. And under them, you have about 6,000 member banks that make up the rest of the network. It's a big operation. And here's a really interesting detail about those governors. They get appointed for a 14-year term, and it's non-renewable, one and done. So why so long? Well, the whole idea is to protect them from the day-to-day political drama. It means they can make tough, maybe unpopular decisions for the good of the economy without having to worry about who's up for re-election next year. So, how does this powerful, supposedly independent group actually do it? how do they steer this massive ship that is the US economy? Well, it basically comes down to three main tools they have in their toolbox. Okay, so the Fed has three big levers it can pull. First up, they buy and sell government bonds, or what are called treasury securities. When the Fed buys these bonds, it's basically injecting cash into the system. More money means more lending. When they sell them, they're pulling that money back out. Simple enough. Second, they set something called the reserve rate. This is just the percentage of money that banks have to keep on hand that they can't lend out. If the Fed lowers that rate, banks can lend out more. And third, and this is a big one, they influence the interest rate that banks charge each other for overnight loans. That rate becomes the foundation for pretty much every other interest rate you see, from your car loan to your mortgage. And what's the point of all this fiddling with levers and rates? Well, the ultimate goal is to find this really delicate balance. They want to keep the economy growing, creating jobs, all that good stuff. But they have to do it without letting inflation run wild and just destroy the value of our money. It's a tightrope walk. But, as you can probably guess, walking that tightrope is incredibly difficult. And the Fed is, well, it's not perfect. It gets a ton of criticism and has to deal with some really tough questions. So let's dive into some of the biggest debates about what they do. So, for starters, there's that whole question of independence. I mean, sure, the governors have those super long 14-year terms. But can the Fed really be free from political pressure when you have a president or a bunch of people in Congress publicly yelling at them to do one thing or another? It's a debate that never really goes away. Then there's another really big point of debate. The Fed has this official goal of keeping inflation at around 2% a year. They call it moderate inflation, and the theory is that a little bit is actually healthy for the economy. But is that 2% really good for everyone? Because here's the thing, 2% might not sound like a lot in 1 year, but you let that happen year after year over a decade or 2 decades, and that slow, steady rise in prices can seriously eat away at your savings. It undercuts your spending power, especially if your paycheck isn't going up by at least that much every single year. And that really brings us to the final and maybe the most important question of all. Look, the Fed's goal is to create economic stability, and in theory, that's good for all of us. But our economy is massive, and it's incredibly complex. Every decision the Fed makes, whether to raise interest rates or to lower them, whether to fight inflation harder than unemployment, it doesn't affect everyone the same way. So the question we have to ask, and the one I'll leave you with, is this. In this difficult balancing act, who benefits the most?